Hello and welcome to How to Invest. In today's video, we're talking about UiPath, which we believe is the next big agentic AI automation player. Just a little bit about myself. I am a stock analyst for a holding company with over $7 million of assets under management, as well as a personal $100,000 portfolio. So just a quick little synopsis about the company. They have been around as a automation company for quite a while, but not in the agentic space. So they did something called RPA, or robotic process automation, which is basically rules-based automation. Basically, you can think if then that type of automations, very rules-based, very stringent, very repetitive, the same thing every time, not creative, not adaptive like an LLM or like a AI agent might be. It has to be the same kind of formulation of data coming in each time, and then it knows what to do with it, and it's very, again, rule-based. So over the last couple of years, they've been developing their AI automation platform to compete with companies like Palantir, like Salesforce's Sales Agent Force, I believe their new product is called. So they are entering the agentic AI automation space, and we believe they actually have a really good shot at being very competitive and able to take quite a bit of market share in this space. So that is the company we're going to be going over today. The company's mission is to accelerate human achievement through the power of AI and automation. So again, their products is the RPA currently, which I just talked about. That is basically what their whole evaluation is currently based on, which I will cover a bit later. So it's almost like you're getting this whole agentic automation platform for free. You're just paying for the RPA platform currently. So we're very excited about this new agentic automation. It has a somewhat of an ontology. It's not quite as built out as Palantir's ontology, not quite yet. It's super important to keep in mind that they've been developing this for, I want to say, about 1 or 2 years now, and they're finally bringing it to market, and they're continuously adding more and more features. So definitely keep that in mind, but they are already seeing some adoption of this platform, and it is already showing some competitiveness to Palantir, and that is why we believe this is an incredible stock for you to go and look into more after you watch this deep dive and perhaps consider it for yourself. So their current business model is to sell subscription services for their cloud-based compute, the robotic process automation, and their agentic automation, plus the early versions of their ontology, data orchestration, that kind of stuff. So they have a bunch of different products with a bunch of different names: UiPath Studio, UiPath Maestro. They have Data Fabric. Just a little bit of disclaimer: I am not super technical. I am not a programmer, so I am very, very surface level understanding this. I'm mostly understanding the effectiveness of this platform from clients, from the people that are actually implementing the software in their companies, and hearing what they're saying about the platform. We'll look at some reviews later comparing UiPath to Palantir and such, and kind of getting a better understanding of how good this product actually is from them, because again, I'm not technical, so I'm not super able to go in there, use the platform, really able to tell, just because I'm not a programmer. So definitely keep that in mind when we're talking about this, that I am not technical. But I think that through research, you can still get a really good understanding by listening to people who are technical and what they are saying about the platform, to really understand if it is actually capable of what the company claims it can do, and what that might mean for future revenue growth, sales, and ultimately the income for the company. So, yep. That is their business model. They do also sell licenses, one-time fees, but that's been declining. I think I'm a much bigger fan of this subscription-based services anyways, because it is recurring. So I much prefer subscription-based revenue anyways, and it seems like they are mainly headed that direction. Just a quick look at the stock price here. We're trading for $11.40 at the time of this recording. And this is basically near all-time lows. All-time lows are $9.38. We're building a massive base here. So it really doesn't want to go below $10. It has definitely some support around $10. And And the company, just for the robotic process automation, is trading so cheaply. So people are really scared about this company because they believe agentic automation is going to completely replace robotic process automation, which, like I've mentioned a few times here, I don't think is the case. And on top of that, we also have Path moving into agentic automation. So just looking at what this business is currently, which is, it's basically everybody in the market is just still viewing it as a robotic process automation company. They are being massively disrespected just as an RPA company. 4x sales with 82% gross margin is just very, very disrespectful. They have not focused on profitability at all. So if they didn't even want to come out with their agentic AI platform and just wanted to continue to sell RPA and start focusing on profitability, this company is cheap. This company is cheap for just their current product, their current RPA product, and you're getting the entire upside from the agentic automation product on top of that, basically for free, because you're getting the RPA product very, very cheaply. So that's just all I want to mention here for the stock price. I think that we have some good support around $10. So I just think this is so asymmetric. Obviously, the stock price can go lower if it really wants to. But if it does, that just means I want to buy it that much more. So I think it's a really good buy point. You're basically getting all the upside from Agentic for free. Really quickly about the CEO and founder, Daniel Dines. We love a company where the founder is still at the helm. He left for a little bit of a tenure and came back pretty quickly, realizing that he still wanted to be steering the ship. And we are really glad that he is here to kind of do what he has called as the Act 2 for the company. So Act 1 was the robotic process automation. Now Act 2 is the agentic AI automation. So he is at the helm. He is very, very competent. He has a kind of killer instinct. He lives to run this company, and he is had an incredible life story. It's been super interesting listening to interviews from him. Just a little bit more about his background. On top of being an entrepreneur and an engineer himself, he's also an investor. He runs a investment firm. He's graduated from the University of Bucharest and is a self-taught programmer. He's worked at companies like Microsoft for a number of years, and then he started his company, and now he's been working on this company for around 20 years. He's been building this company, originally called Deskover, now renamed UiPath and headquartered in New York City. So he has had an incredible journey. He's been around technology his whole life. He is very intelligent. He does have a very strong Romanian accent, but is very, very intelligent. You can tell by listening to him. So we'll just quickly go over the bear case, bull case in terms of like what kind of threats exist, what could be the worst case scenario, and then more of the bull case, which obviously is what we think is the more likely scenario. So the bear case here is adoption of their new agentic automation is slow. This could be for quite a number of reasons, just doesn't quite have as good as features. Other offers are more competitive, better price, those type of things. And then on top of that, the robotic process automation is also replaced by agentic AI. I don't think this is going to be the case, as I'll explain a little bit more in terms of the use cases for RPA and agentic automation do have some overlap, but there are some very, very clear use cases where you do not want the AI to do a different process every time. It's a very simple task that you want to be done the exact same way every single time. So I think there will always be use cases for these RPAs, rule-based automations. And so I don't necessarily think this is going to happen, but you could get to a place eventually with maybe AGI that it's just much easier to say, hey, AGI, artificial general intelligence, I need you to do this task, which does require a bunch of rules-based tasks, but it's just so intelligent it can go figure out itself. So that is the worst case scenario. I don't see that happening super soon. You do have leaders in the AI field, like the leader of DeepMind, saying that he doesn't think that AGI will be around for another 10 years or so. So this is something that is far out into the future, but we'll definitely keep an eye on. It is a potential threat and risk to the company. Now, the bull case, where we think this is going to be the much more likely scenario, which is their new AI agentic product is massively adapted. There's tons of customers they already work with, Coca-Cola, they work with Turkish Airlines, with quite a few number of banks, massive healthcare providers. all that are already integrated into the robotic process automation platform. And now they have this new agentic AI product that they're able to cross-sell. So they already have the foot in their door with all of these clients and customers. They already super like the RPA product, and now they can just cross-sell this agentic AI product as well. So I think there is a lot of reason to believe that this new AI product is going to be massively successful, and you can see it meaningfully impact the revenue line. And it is competitive with Palantir. Now, they didn't explicitly say they competed with Palantir in this case. I'm just going to go over here. This is from the latest earnings call. So they talked, this is Daniel Dines talking. He said, a standout example is a 7-figure deal with the Fortune 15 global technology company in a competitive win. So this is where we think they are potentially competing with Palantir. We don't know for sure, but they're definitely competing with other software companies offering similar automation products. And this is UiPath beating them out. They were able to win out against the competition. They chose UiPath to power their SAP transformation and reinvent employee operations across functions like supply chain and manufacturing. They chose UiPath for our broad platform, including application testing, process intelligence, and agentic automation, and our proven ROI in complex enterprise environments. So this is why we do think that UiPath is competitive in here. This is a Fortune 15, so one of the 15 largest global technology companies, and they are being competitive and beating out competitors' bids for this type of to come in and automate things inside of this company. So this is why we do think it does have a competitive edge and can compete against companies like Palantir. They are winning 7-figure contracts for automation, which include this AI, agentic AI automation. So on top of that, they have already a few use cases where in one enterprise, they're able to save 18,000 hours of basically employee time, and then saving $100 million at a healthcare provider through automation. So, and like I was saying, RPA in the bull case is still massively useful. Daniel Dines, as I mentioned before, says there will always be a space for this rule-based tasks. You do not want AI to, if you ask the same question to an LLM, you'll get a different answer every single time. A lot of times for these kind of rules-based tasks, you want the same answer every single time, like a calculator, basically. So, the bull case is this AI product is massively adapted, which I think there's a lot of argument for, and their RPA continues to grow sales because it's just such a useful product and doesn't get replaced by AI automation. Now, it is a little bit of a turnaround. We'll look at the revenue numbers here in a second. But it was shrinking for a number of quarters, and now we're starting to see the first two quarters of accelerating growth, and we believe this is going to continue. So like I was just mentioning, the year-over-year growth had been slowing. We'll go ahead and look at macro trends real quick. So this is the revenue growth. You kind of had a peak here on the January 31st, 2024. Their fiscal year kind of ends at an awkward time. So that is the end of the quarter is January 31st, not December 31st. So they have kind of a weird fiscal year, but that's beside the point. You had a peak here of 31% year-over-year growth, and that kind of slowed down into January. We saw the bottoming here of 4.7% year-over-year growth. So that was Q4. So I have these all pulled up. So this is Q4 2025. This is the bottom right here, 5% year-over-year growth. And then the last 2 quarters, it's been re-accelerating. So Q1 of 2026, we had 6% year-over-year growth. And in Q2, we saw a massive re-acceleration in revenue growth to 14% year-over-year revenue growth. On top of that, ARR is growing 11%. So that's annual reoccurring revenue. So, and that's at $1.723 billion. So I'll talk about that a little bit more in a minute. All right, so we are seeing revenue already accelerating, and in these earnings calls, Daniel Dines is saying we're really not even seeing the acceleration through agentic automation. He thinks that will come in fiscal year 2027. So that is fiscal year 2027 will start February 1st of 2026. So we're still about maybe 4 or 5 months away from when Daniel Dines is really saying we're really going to start to see the effect of AI agentic automation really start affecting revenue. So I think that's super, super bullish. We are here early for sure, 5 months until that we really start to see that, and we're already seeing a pickup in revenue. So I am very, very excited about that trend that we're seeing there in the revenue growth. Free cash flow, it fluctuates from quarter to quarter, but is strong. They do have positive free cash flow as well as positive net earnings. It's very, very low margin, net margin percentage. I don't think they're really too focused on profitability at this moment. They're really focused on getting this new agentic AI automation platform out to customers to really see that growth acceleration on revenue. So I think the insane free cash flow growth and the net margins increasing to potentially, I think 30% is very possible, 35%, as they have super high gross margins, which we'll see in a second, around 80, 82%, which is actually higher than Palantir. So we'll quickly talk about their track record of execution. They consistently beat kind of analyst expectations. So we'll just look here at the earnings per share over the last couple of quarters. The last 4 quarters, they can beat all 4 quarters the expectations. So they are consistently beating even their own guidance as well. They exceeded their own guidance for Q2. And so I think they are probably seeing more success than even they were thinking they were going to be seeing at this point for the new platform. But yeah, still watching this. We're still proving out the thesis, but we're pretty confident that our thesis is correct. Every quarter, we will reevaluate this thesis and make sure that we're staying on track and we're actually seeing what we're expecting to see. So, so far though, so good. All right, management guidance. They're only guiding for around 10% year-over-year growth in the next quarter, and they haven't really put out much guidance beyond that. But again, they're saying we're really expecting to start to seeing the agentic automation growth in fiscal year 2027. So we're still a little ways away from that. How will they achieve that growth? Well, first off, they have an incredible 108% net dollar retention, which means on average, they keep all of their customers and those customers spend an additional 8% compared to what they spent the previous year. So even if they did not make new sales, their revenue would continue to grow consistently through this net dollar retention rate. So that just really proves that their product is really, really sticky. Customers really, really love that product. They consistently continue to use that product and purchase more robotic process automations. So I don't think this number really includes agentic AI yet, but that just kind of shows how sticky their RPA product is. So, from what I can see, their RPA product is actually the best in the market. So, all right. Yeah, I already talked about onboarding the Fortune 15 customer again. So they will achieve the growth through continuing to sell more RPA and through this new AI product. All right, market cap, $6 billion just around, but the enterprise value is actually $4.4 billion, and that is because they have a very, very robust balance sheet with about 2.6 billion in assets with only about a little less than 1 billion in liabilities, which means they have a net asset value of $1.66 billion in NAV. So that's more assets than liabilities. So that's how you get this $4.4 billion enterprise value. So, and we view enterprise value as a much better metric for price, what you're paying for the company, than market cap. Because if you buy a house and it's a $100,000 house and there's $50,000 of cash inside the house, you didn't pay $100,000 for the house. You paid $50,000 for the house. So that's kind of how we view it. So now let's continue to revenue. And this is where I want to talk about the ARR again. So trailing 12-month revenue is about 1.5 billion as of Q2. And their ARR, so annual recurring revenue, was 1.723 billion. So that means that even if they did not continue to sell any more product to their current customers or to new customers, they'll see a 10% revenue growth over the next year, just as they realize that annual recurring revenue. So I think we can really start to see re-acceleration in the revenue growth. And worst case scenario, they continue to grow at 6% and they're just kind of really undervalued, as we'll see in a moment. They just if they focus on profitability, continue to grow at 10% is an incredible investment still. So yeah, gross profit here, which means they have 82%, almost 83% gross margin, which, as I mentioned, is actually better than Palantir. So this is the trailing 12-month free cash flow, earnings, net profit margin. So very, very low net profit margin, 1.35%. But a company with a gross margin of 83%, basically, you could see that go to 30, 35% very, very easily if that was what they're focused on, which I do not think that is at all what they're focused on, which I'm happy. I would much rather see them grow the top line than try to focus on growing the bottom line. That will come eventually. But as a long-term stockholder, a long-term investor, I really want to see them re-accelerate that top line and worry about the bottom line later. All right, so yeah, that does make the PE ratio look quite ridiculously high, but keep in mind that is literally, they're only recognizing 1.35% of their revenue as profit. With the gross margins, they could easily focus on growing that, and the PE ratio would fall dramatically quickly. So we'll look at a couple of these in respect to other companies and look through. So if they could get to, I believe we're estimating them getting to around a 35% net margin, you're really only paying an 8 PE ratio if they were actually having their terminal net margin on their current revenue. So incredibly undervalued by looking at it this way. So all right, we'll continue through this because we'll look at all of these relative to other companies here in a minute. So now let's go to the competitive analysis. So the robotic process automation TAM is around 4 billion currently, growing to 30 billion. This is by one research article I found. Another said that it's the RPA CAGR, compounded annual growth rate, is about 38%. So somewhere in that 38 to 44%, the RPA market is growing. So that's just the robotic process automation. That doesn't even, include the agentic AI, which agentic automation is growing at closer to a 44% compounded annual growth rate. So when we look, these are important compound annual growth rates to keep in mind when we look at what we think the revenue is going to be growing at, because we believe we are potentially being conservative in this. So yeah, those market growth rates are 38-ish percentage and 46%. Obviously, these are people's projections. So, if we are hoping they're not going to be perfectly correct, but if they're directionally correct, we are seeing the RPA market growing around 35 to 40% annually, and that the agentic automation market's growing 40 to 50%. That means that the total market size is growing very, very quickly. So there's tons and tons of room to expand into. So just talk about real quickly some of the comparable companies. Obviously, the one that comes to mind first is Palantir. There are a few other competitors entering the space. Salesforce has their Agentforce product coming to market now, which is also growing very, very quickly. I think over 100%. I think we're going to be doing some research into Salesforce as well. This is one of the things where there probably won't be only one company in the space. Right now, Palantir is kind of seen as the de facto monopoly. I think that's going to quickly fade as a bunch of other platforms enter the space. Salesforce, you have an open source one, N8N. Microsoft has their own RPA, not agentic. Power Automate, and that's from Microsoft. I've watched some comparisons on that. It just seems like the Power Automate is a lot more basic, doesn't really have as much features, is not really competitive to UiPath for people who are technical. There's just way more you can do with UiPath in terms of automation. So the real kind of competition here is for the agentic automation. And that competition is against companies like Palantir, Salesforce, and N8N. So what is UiPath's Moat? So their software is very agnostic, most are, but on top of that, you do have the RPA. So if Daniel Dines is right about this, then this will be a very, very good kind of cross-selling, they work in tandem. They push each other forward. So not only can you use agentic automation, which will be super, super useful in a lot of use cases, some cases you're going to want that RPA. So if you can get a software company that offers you both, this is the word I was looking for, there's synergy there. So this is really where I think they probably have the greatest moat, is a lot of these companies are already using them for RPA. RPA is not something that Palantir offers. They don't offer robotic process automation. So, and I may be wrong about that. This is again where maybe my technicality, I don't, from what I understand, they do not offer robotic process automation. You can hook in, a third-party platform to Palantir for robotic automation, but they do not offer it as their own type of software to their customers. So there's a synergy there for UiPath. This is something I do want to talk about. It may be a little bit too little data to really make a conclusion, but they actually, from what I've seen, so coming from this website, G2, this is a direct comparison between Palantir Foundry and UiPath's agentic automation platform. These are the reviews for them. So looking at the star rating, Palantir Foundry only has a 4.1 stars out of 5, whereas UiPath has a 4.6 out of 5. So based on this, it's a little bit hard to say for sure, as the Palantir Foundry on this website only has 12 reviews, whereas the UiPath has 7,000 reviews. So I'm much more confident that this is the actual star rating that UiPath has, where I'm a lot less certain that this is actually how people feel about Foundry, just because it's so many less reviews. But this is something, this is showing that potentially UiPath actually has a platform that people like using better. Now, if I was going to still man the other side, I think Palantir makes beautiful looking products. So, and this is basically the Mega Man argument. What's the difference between a villain and a super villain is presentation. So what is the difference between a good automation company and a great automation company? Presentation. So Palantir is definitely the winner there in terms of presentation. They have a much nicer looking platform. We'll just quickly look over the different platforms. So this is what UiPath's kind of a agentic automation builder platform kind of looks like. It's very modular. It's very similar to N8N, which I have built in automation. This is an automation I built in N8N. Again, even N8N looks slightly better than UiPath does. I actually chose N8N over Palantir because I found it much simpler to use. Now, again, I'm not technical, so that's just for me as kind of a non-technical person. I found N8N easier to use. I didn't know about UiPath at the time, so I didn't really look at it. But this looks very, very similar to, N8N. I probably would find this much easier to use if it is similar to N8N than Palantir Foundry. This is kind of what Palantir Foundry's AI builder looks like, which I found much more complicated. You needed much more programming skills. It was not as plug and play. It was much more difficult for someone like me to access, to understand, to implement. But it was a very interesting thing to use all these different platforms. So, very similar, not as polished as Palantir. This looks very nice and professional. This also looks, intuitive. It's a little bit more utilitarian. It doesn't have quite that polished look. Even N8N's a bit more polished. But what really matters here to these companies is not how it looks, it is the actual usefulness. Can people like me in their company who are not technical actually use these automations? In that sense, I do actually think that UiPath probably has the advantage here. So, yeah, I don't know if there's much else on this website to look at. I do recommend going and looking at this. But yeah, these are super, super interesting, like meets requirements, UiPath's winning, ease of use. Again, this is where I'm kind of saying that I think UiPath's a bit more user-friendly, especially for non-technical people. It ranks higher in terms of ease of use. They didn't even rank some of these qualities of support. So UiPath as a company giving better support, product direction, much better there. I don't know exactly what product direction means, but UiPath is winning in the reviews here. So again, some of these things, they don't really have reviews on either side. So yeah, see, RPA, I'm pretty sure, and I could be wrong, that Palantir does not offer robotic product automation. Now, data preparation, this is definitely something that as a feature, UiPath, I do not believe is presenting or has a feature for. So they do have their data fabric, which allows you to bring in data from a bunch of other platforms and kind of create a new data set inside of the UI platform so that you can create better automations based on collected data. So say they gave the use case of a employee file where some of the information about the employee is in multiple different software platforms, and the data fabric is able to take all of those data about that employee and kind of put it all into one data set that the AI automation, RPA, or the Agentic can use to complete a task. So yeah, but in terms of presenting that data so that you can make decisions based on that data, and this comes back kind of to the presentation point, I don't think UiPath has really started implementing any kind of data preparation yet. So for people who want their data to be collected into one place and presented to them so that they can make decisions, I do think Palantir probably has an edge here. So again, there's still so much that I'm sure I do not understand here. Just not being technical myself, but it is super, super helpful seeing platforms like this G2.com comparing the two companies. So I do recommend going and reading this if you want to learn more. So, all right, back to our spreadsheet here. Yeah, and this is kind of what I said. I do think Palantir is further ahead in terms of features, but UiPath is constantly building out more features. UiPath's a bit in earlier days in terms of agentic AI and ontology features. They're still developing those out, and I don't see any reason why UiPath won't eventually be able to make a product as compelling as Palantir. Again, it may never be quite as polished, and if Palantir, which I do think they have an incredible team there, they will continue to innovate. So you could definitely see a kind of world where Palantir is always slightly ahead of UiPath in terms of features, polishedness, just because they had that kind of lead at the beginning and they continue to push forward new features and such. But UiPath is always going to be right there on the hills, and for enterprises, this is where it is also a little unknown to me. I don't know how their prices compare. So, but if UiPath is more price competitive and can offer maybe 80% of the features, that's what matters to the enterprise. They can get 80% of the functionality for maybe 50%, 20% of the price. I really don't know how the prices compare. So this is a little bit more conjecture, but you can see somewhere where, even though Path is behind in features and applications, they're consistently, taking more and more of the market because what they do have is just so much more compelling to enterprises. And that's what really matters at the end of the day is product market fit. So, all right, industry mature market cap. So Palantir 370 billion, Salesforce 231 billion, which is insane because Salesforce has so much more revenue than Palantir. But the market is quite exuberant about Palantir at the moment. The average between Palantir and Salesforce, 78% gross and 19% net. So this is again where we're thinking that UiPath as a company has so much to gain in terms of their net margin. And I don't think either Palantir nor Salesforce is kind of at their terminal net margin either. I think both of them are going to continue to improve as well. PEs are a bit exuberant. That's incredibly kind of diluted by Palantir's quite insane evaluation at the moment. But basically this just says that, the market is getting very, very excited about companies like Palantir and Salesforce, which means they could easily get excited about companies like UiPath as well. And we could just see this crazy kind of exuberant kind of evaluation put on Path, which could be fun if you're an early investor. But I do think that that does kind of lead to some unrealistic evaluations to these companies. But all right, let's go to our modeling really quickly. We'll end here. And then we'll look at some metrics and kind of our final buy checklist. So this is the bear case. This is the lower end of their revenue growth projection and guidance. Basically, in our bear case, we say that they grow 8% in the next year, and then they grow about 10% through the next 20 years. And keep in mind that the market growth in the two industries that UiPath are in are growing at like 35 to 50%. So 10% revenue growth for UiPath means that they are constantly losing market share. So this is our bear case, constantly losing market share, but they're just in such a fast growing industry that they're still able to grow revenue by 10%. And once again, remembering ARR as well, their ARR without making any additional sales would also see their revenue grow 10%-ish. So this is our bear case. We do not really see a world where they continue to shrink. So now in our base case, so this is what we think is most likely, see a 12% revenue growth over the next year. And I think that as their agentic AI platform comes out to market, we could see a significant acceleration in revenue growth. So that's kind of what we're modeling here, an acceleration in revenue growth year over year from 12% to 15 to 18% to 20 to 22 to kind of a peak 25% revenue growth for 2 years, and then starting to see that decelerate over a number of years with a pretty solid 20% for quite a few number of years, and then kind of down to a terminal 10% revenue growth in year 20. And again, even in this situation, that is actually a slower revenue growth than the market. So even in our base case, we're saying they're losing market share in the market. So I just think this is highly still conservative. So, and finally, for our bull case, you'll see 15% over the next year, accelerating to a peak of 30% instead of that 25%, and 32% peak actually, and then seeing a deceleration down to a terminal of 15% year over year revenue growth in year 20. In our bear case, we have 3% with a max of 15% net margin. I think this is very conservative. Even the current players are getting 19%, and UiPath still has that better gross margin. So base case, getting up to that 35% net margin. I think this could be a little bit bullish, but I do think it is also definitely possible. And then in our bull case, getting up to 38% net margin in year 20. So we'll go past this. Basically, I think, PE ratios, we'll just look at that pretty quickly. Very, very bearish 25 PE ratio, going down to a 20 PE ratio in year 20. In our base case, 100 kind of slowing down, going down to multiple compression of 25 in year 20, and then our bull case going from a 250 PE to a 50 PE compression. So, and again, we're thinking about Palantir has over a 500 PE ratio. So this is saying that, even in our bull case, the market doesn't even get nearly as excited about UiPath as it has about Palantir. So in our bear case, there's no share dilution. In our base case, or share buybacks either, we are actually saying share buybacks. They're currently doing share buybacks. So it's about, I think, a 2% compounded annual share buyback is what we have in our base case. And then I think in our bull case, we have a 2.5% annual share buyback in our bull case. So we can see what that does to returns now. If we go over to our charts page, we'll just zoom out here. So ROI, we have path here. This is the line for path. So in our 1 year, we're saying the intrinsic value should be about double what the current market cap is. And remember, these are not going to be exactly correct. These are just projections. The idea of these are to be directionally correct. So this is the direction, the generic direction we think that the intrinsic value, not the stock price. The stock price, there's just no ways to predict. We're saying this is what the company is intrinsically worth. So intrinsic value and price are two separate things. The market determines price. We are trying to really understand what the intrinsic value, based on where we think the revenue is going to go, the net margin is going to go. And we do believe that over time, price does follow loosely the intrinsic value. So this is just directional projections. This is not descriptive. We have no way to actually tell the future. So in our 1 year, we're saying that the intrinsic value of this company is going to double. Over the 5 year, we are saying it's going to over 6x. 10 years, we're projecting a 25x. And again, these are based on our base case, the numbers I just went over with you. And then in the 20-year, 130 times the value and compared to its current value. So that's our base case. In our bull case, we'll go over it quickly, an 8x in 1 year, very, very bullish, a 20x in 5 years, a 100x in 10 years, and a 700x in 20 years. So that is our bull case. It is able to accelerate to 32% revenue growth, have even better net margins, all that kind of stuff. A bit of more of an exuberant multiple evaluation. And then lastly, let's look at our bear case. So bear case, they're only 0.3 or 30% of what they're currently valued at in 1 year. 1.1 times what they're worth now in 5 years, 2.6x in 10 years, and then a 6.8x in 20 years. So this is saying even in our bear case, worst case scenario, where they continuously lose massive market share in not only the robotic process automation, but also in agentic AI, they're actually still doing just as well as the overall market. So this is our benchmark here, the S&P 500, over 20 years at a 10% annualized return, it's a 6.7x. Let me double check that real quick. I believe we have it grow at 10%, I believe. Yes. So, and that's kind of the historical. That doesn't account for inflation, but yeah. So every 20 years, the S&P should about 6.7x and Path should 6.8x, even in our bear case. So I think this is a very, very safe investment with very limited downside. Worst case scenario, and according to our projections, which are just projections, it still does just as well as the market. So all right, let's look at how it compares to some other companies. This is the price to earnings ratio, very high, but again, we have to keep in mind the net margin and the gross margin. This is the enterprise value, which obviously makes it a lot better. We prefer the enterprise value just because, like I mentioned earlier, if you buy a house with cash in it, the real price you paid is, much less. So this is through the look-through earnings. So enterprise value to look-through earnings. So what their revenue would look like for earnings in terms of their terminal net margin. So if they were making 35% net right now, their price to earnings ratio would actually only be an 8.4. So, and then their enterprise value to free cash flow, this has fluctuated a bunch. We haven't really filled out a bunch of these yet, so not too much to compare to there. We're looking at Fubo, Fiverr looks really cheap here in terms of their enterprise value to free cash flow. But we need to fill that out a bit more. Enterprise value to sales. So enterprise value to sales, they are actually looking very cheap here as well, especially when you consider the amount of gross margin they have is just insane. They can turn so much of that revenue into profit if that's what they were focusing on. Very cheap, much cheaper than companies like, Micron, AMD, SoFi, and such. So price to book doesn't really matter. They're not really, like an asset heavy company. It's a software company, it's a software as a service company. So very asset light, but even so, they have a very, very good book value. They have a good net asset value. So very strong balance sheet. This is what you're paying for revenue growth. Revenue growth, you're paying a 0.24, which is very, very cheap. It's not as cheap as some of our other favorites like Lemonade. I really like Hims, but is very, very cheap, especially compared to like Tesla or Nvidia, even SoFi or Rocket Labs. Much cheaper cost to growth. And then this is one of our favorite YouTubers, Beat the Denominator. This is his enterprise value to gross profit to revenue growth. And you can see here, when considering their gross profit, which considering their gross profit margin, they're looking incredibly cheap, which I really love looking at this metric because, it takes into account what a company's gross margin is. So when a company is just getting to profitability or they haven't really focused on profitability yet, this is a really good way to kind of look at, what you're paying for that growth. So you can pause and look at this chart as well. Short interest, they have a decent amount of short interest, not crazy amount, but a decent amount there, which, always could be fun for some short-term price action movement if you get like a short squeeze or such. Nothing too crazy, nothing like Hims. This is very, very high. I'm sure it's a bit lower now. They just had a crazy run up. So I'm sure there's a lot of people that got squeezed out and kind of helped the the stock shoot up. It had a few like 7% updates in a row this last week. So all right, I think that is everything I wanted to go over. I hope that you found this very, very entertaining, very educational. I encourage you to go do your own research. If you want more deep dives like this, make sure to like and subscribe so you can get notified every time we drop a new deep dive like this. Go and watch some of our other videos on other companies that we have researched, and I hope you have a wonderful, wonderful day. Okie dokie. Okie dokie.
Oh, how's it recording already? That's crazy.
What are you doing? I'm not decent.
Why is it not stopping?